Stocks for the Long Run by Jeremy Siegel is a comprehensive guide on the historical performance of stocks and the principles of long-term investing. Here's a step-by-step summary of the key lessons from the book. 1. Historical performance of stocks. Long-term growth. Over the long run, stocks have consistently outperformed other asset classes, including bonds and cash. Historical data. Understanding historical market data is crucial for setting realistic expectations about future returns. 2. The power of compounding. Compounding returns. The power of compounding significantly enhances the value of investments over time. Starting early maximizes this effect. Reinvestment. Reinvesting dividends and capital gains accelerates growth through compounding. 3. Risk and return. Risk premium. Stocks offer a higher return than bonds due to the equity risk premium, which compensates investors for taking on additional risk. Volatility. While stocks are more volatile in the short term, they tend to smooth out over the long term, reducing risk. 4. Inflation and real returns. Inflation hedge. Stocks have historically provided a good hedge against inflation, preserving and increasing purchasing power. Real returns. Focus on real returns to assess the true growth of investments. 5. The case for global diversification. Global markets. Diversifying investments across global markets can reduce risk and enhance returns. Currency risk. Be aware of currency risks when investing internationally, but understand that global diversification generally benefits portfolios. 6. The role of dividends. Dividend reinvestment. Reinvesting dividends contributes significantly to long-term growth. Dividend yield. Consistent dividend-paying stocks can provide stable income and growth. 7. Market timing and long-term strategy. Market timing risks. Attempting to time the market is generally unproductive and can lead to missed opportunities. Buy and hold. Adopting a long-term buy and hold strategy tends to outperform short-term trading. 8. Behavioral finance and investor psychology. Behavioral biases. Recognize and mitigate behavioral biases such as overconfidence, loss aversion, and herd behavior. Staying disciplined. Maintain a disciplined investment approach, especially during market volatility. 9. The impact of economic and political events. Market resilience. Historically, markets have recovered from economic and political crises, underlining the importance of a long-term perspective. Event-driven strategies. Be cautious with strategies that react to short-term events and focus on long-term fundamentals. 10. The efficient market hypothesis. Market efficiency. Understand the degree to which markets are efficient and reflect all available information. Active versus passive. Recognize the challenges of consistently outperforming the market, and consider passive investing strategies. 11. Portfolio construction and asset allocation. Diversification. Build a diversified portfolio to manage risk and achieve stable returns. Asset allocation. Allocate assets based on individual risk tolerance, investment goals, and time horizon. 12. Practical investment strategies. Equity indexing. Consider index funds and ETFs for low cost, diversified exposure to the stock market. Regular contributions. Make regular contributions to investment accounts to take advantage of dollar cost averaging. Review and rebalance. Periodically review and rebalance your portfolio to maintain your desired asset allocation. By following these lessons, investors can develop a robust long-term investment strategy that leverages the historical strength of stocks while managing risk through diversification and disciplined investing practices.